Hello and welcome to the Westpac Macro video. I'm Sean Callow, and joining me today, Robert Rennie, Head of Financial Market Strategy. Welcome, Rob.
Thank you. Good to be here, Sean. It would be nice if we were doing this face to face.
Yes, so another home video check-in there. We use the technology we have in these times. But Rob, I wanted to talk to you this week about what's been a very hot topic recently in terms of Australia's exports, and that was the reports, and these are unconfirmed, at least at an official level as far as I know, but that China was restricting and potentially maybe even just stopping all imports of Australian coal. So what do we know about this? And can you give us some context, Rob, in terms of how China manages its coal imports in a given year?
Yeah, look, Sean, it's a good question because I do think you need to put it in context, and it is probably slightly complicated. Look, once a month at the beginning of each month, I sit down and I run what I call my bulks export process. So I run a bunch of high frequency shipping models, which give me actually a very, very accurate forecast for the physical volumes of coal, iron ore, and LNG exports from Australia. So simply by following shipping coming in and out of the various ports, I can get a forecast which is actually incredibly accurate, and gives me almost a live view of what's going on from a bulks export point of view. And in that bulks export monthly that I pop out at the beginning of each month, I've actually been noting that I've been slightly surprised that we've not yet seen evidence of a go slow or a physical ban taking place in terms of Chinese imports. And that, as you asked the question, it's very much around the fact that that China manages what I call a soft quota system, and it's basically managed on the fact that in 2017, China imported a total of 270 million tons of combined coals from around the world, and essentially they're trying to manage or limit coal imports to that level on any given year. I use the word soft quota because it's not something that really appears to be written down anywhere. And this is where, I think Newswires, etc., are doing a good sort of job of at least covering developments, but maybe not giving us all the context. I do remember November last year sitting down in that bulks export, noting, for instance, that thermal coal exports out of Newcastle had dropped enormously in the month of November. And that very much coincided with the fact that at the time, imports into China were running well ahead of that quota, and we did start to see signs of the Chinese authorities beginning to slow imports, with particular focus on thermal coal coming out of Australia. So again, I'm not really particularly surprised, and the point that I've been making in that bulks export through August and September was that Chinese coal imports year to August, September are up about 17% versus that 2017 quota baseline. And I think importantly, I would make the point here that Australian met coal exports to China are up about 23% year to date versus last year. Thermal coal exports into China are up about 13% year to date, and that gives us a total of 20%. So I think it's very natural that we see this go slow. I do expect it probably continues into the end of the year, but when we get to January, or probably into February and March of next year, when we free up the quotas, it's a new quota year. I would certainly expect Australian coal exports, and indeed exports from other countries that export coal into China, to resume very much as you would expect them to do so.
Okay, that was interesting in terms of the different types of coal. So how would you just briefly summarise the outlook for Australian exports of the coal that's made that's involved in steel making as opposed to energy production?
Yeah, look, that's a very good question. At the moment, we're actually seeing record pace of steel production in China. So what that essentially is doing is sucking in the raw materials that are required. One of those raw materials is iron ore. The other is met coal, metallurgical coal, and that is the carbon that is used to is injected into the blast furnace to toughen up the steel. So that is absolutely necessary. Interestingly, at the moment, we've actually seen arbitrage levels. So if you look at met coal prices as they leave Australian coal ports in Queensland, and the prices that are trading in China, there's an arbitrage somewhere in the region of about $80. If I just do this fairly unscientifically, if I look at Queensland hard coking coal, and I look at the Dalian coking coal contract, the futures contract, and convert it into US dollars, allow for tax, and look at the differential. So I'm not allowing for any basis or any carbon content differential. I'm just looking at the simple price difference. But the difference is about $80, which is unusually wide. And that really reflects the fact that if we are finding it difficult to get met coal into China, domestic met coal prices are going to rise. That then impacts Chinese steel margins. And that's where trying to maintain a quota system and not seeing steel margins decline too much. It's an important balance that I think the Chinese authorities will have to monitor. And what that basically guarantees is, even if we do see a go slow, I think it's very unlikely that we would see coal exports, for instance, shudder to a complete stop. And that really reflects the fact that met coal prices domestically are rising. And again, damaging steel production when you were basically trying to inject liquidity into the Chinese economy, I'm not sure that would really help the situation.
Okay. And there are obviously these unconfirmed reports that Australia is being discriminated against, singled out in terms of China has a number of countries from which it imports coal, and so maybe it's Australia getting a stop, whereas others may continue at some pace. With that, as I say, is all unconfirmed, but obviously that is a hot topic. It's been running for quite some time. What would you say, if we're looking to the next 12 or months, are the main vulnerabilities and strengths of Australia's exports to China?
Yeah, well, look, I mean, obviously, when you look at Australian exports to China, we were talking about it earlier on today, and in the last fiscal year, I think we were looking at Australian exports of somewhere in the region of 160, 170 billion. And that's merchandise exports. The very vast bulk of that is obviously made up of iron ore at the moment. Clearly, Australia dominates supply of iron ore into China. And as I mentioned before, the month of September, we had industrial production data out at the beginning of this week. Steel production in China came in at a fresh record of high of 91.2 million tons. That's up 11% on a year-year basis and 10% on a 3-month year-year basis. And if you look at year-to-date production, China's produced 5.5% more steel this year than it did in the previous year, and 14% more than it did in 2018. So this incredibly fast record pace of steel production basically means that key raw material, i.e. iron ore, is very much in demand. China in September imported 108 million tons. That's the second highest amount of iron ore that's imported on any month on record. And that means that the 3-month year trend is up about 13%. Essentially, China has imported about 83 million tons more of iron ore year to date than it did up to September of last year. So insatiable demand for iron ore basically means that total merchandise exports to China of about 60 billion per year. If about 100 billion of that is very much guaranteed, at least in the short term, I still think that is a positive story, even if we are concerned, for instance, about coal and the other commodities, beef, wheat, cotton, and potentially wine as well, that seem to be being impacted. One word of caution, though, as we move forward over the next couple of years, China is increasing berth access for what we call in the industry very large ore carriers, or VLOC vessels, and those vessels are particularly suited for the routes from Brazil and indeed from Africa as well. And obviously, there's a new mine in Guinea that potentially will be opened up over the next several years. So increasing access to these very large ore carriers, which essentially carry 400,000 metric tons rather than the standard 200,000 tons, that actually does favor exports out of the like of Brazil and Africa as well. And I think that's something that we've probably got to watch in coming years. And certainly as I sit and watch shipping activity out of Brazil, I am noticing quite a sharp pickup in terms of VLOC activity out of Brazil. And I think that's an interesting dynamic that I'll probably be writing about a lot more through the end of this year and into next year as well.
Okay, no, that's a very interesting point. So obviously a bit of a challenge to Australia's natural advantage from the fact that the coast of Western Australia is closer to Chinese ports than is Brazil. So interesting stuff. But as you say, iron ore is still very strong at this point. We're about $120 a tonne. Yeah, so that's very good backdrop for the Aussie. It has to be one of the reasons that the Aussie's been able to hold up okay over the course of this year. So look, thanks very much for that insight, Rob.
Thanks, Sean.
And thanks everyone for watching, and we'll speak to you next week.